Everyone. Today we're going to talk about master budgeting, and we have a worksheet. So before we get started, make sure you pull up the worksheet, Master Budgeting Worksheet 1, so that you can follow along with me. You can either follow along online, or if you want, you can print it out, and then you can use pen and paper or pencil and paper. Okay, so I'm going to Master Budgeting Worksheet 1. The example we're going to go through is in your book. It's from the Need to Know, which is throughout the chapter. It's kind of got a blue background. Need to Know 20.6. So if you want, you can look it up and get some information from there as well. What they provide for us is a balance sheet. We're doing a master budget for Payne Company, and we're going to do it for the second quarter, which is April, May, and June. So we have a balance sheet as of March 31st, so the last day of the prior period. And then we have a bunch of additional information which we are going to need to create our master budget. I'm going to split this into two. We're going to start with the operating budget, and I'm going to go through the sales and product cost budgets first, and then we'll do the sales cost and admin and other second, and then we'll go on to the cash budget, the income statement, and the budgeted balance sheet. Okay, so we're going to start with our sales. We always start with our sales budget because once we know how many we think we can sell, how many units, then that determines how many units we are going to make. And how many units we're going to make determines how much materials we need to buy and how many direct labor hours we need to schedule. So it all starts with the sales. So I need to know what are my budgeted sales in units. So I'm going to go to my other information. And in A here, it says our sales for March were 10,000 units, and our expected sales in units are 10,500 for April, 9,500 for May, 10,000 for June, and 10,500 for July. Okay, so I'll just go ahead and put in here 10,500. I think we had 9,500 for May. Let's just go back and look. 9,500 for May, 10,000 for June, and 10,500 for July. Okay, that's our budgeted sales in units. Now you're probably saying, hey, I thought we were just doing April to June. Why do you have July? We're going to need that July information to fill in some of our April through June budgets as we go further down. So we'll just have that for the sales side. All right, so that's our units. What are our sales dollars? Well, let's go look. And it says here in the second line of A that our product selling price is $25 a unit. So I'll just go ahead and put 25 here. And that tells me that my budgeted sales in dollars for April is 262,500, May is 237,500, and June is 250,000. All right, now we have our sales budget. Next, we're going to go to our production budget. Our production budget is going to be budgeted ending inventory plus budgeted sales units minus budget or beginning inventory. So let's start with our budgeted sales units because we have that information super handy. All right, budgeted inventory. Let's go look. It tells us in B that we have a company policy that calls for a given month's ending finished goods inventory to equal 80% of next month's expected sales units. All right, so my budgeted inventory is next month's expected sales units, which is 9,500 for May, times 80%. And I'm going to do that. So for May, my ending inventory will be June's expected sales units times 80%. My June budgeted ending inventory is July's expected sales units times 80%. Okay, then we have to subtract beginning inventory. So for April, our April beginning inventory is our March ending inventory. And in fact, it tells us that our March 31st finished goods inventory is 8,400. So I'm going to do minus $8,400. Okay. May's beginning inventory is going to be April's ending inventory. So minus April's ending inventory. June's beginning inventory is May's ending inventory. So I'm going to say minus 8,000. Remember, this month's beginning inventory, or this period's beginning inventory, is equal to last period's ending inventory. All right, so now I have my production budget. In April, I'm going to produce 9,700 units. In May, I'm going to produce 9,900 units. And in June, I'm going to produce 10,400 units. Okay. On to our direct materials budget. So our direct materials budget is going to be budgeted production units times the material required for each unit in pounds, which will give us our total budgeted material required. Then we're going to add budgeted ending inventory and subtract beginning materials inventory to get how much must be purchased. Then we're going to multiply that by price per pound, and we're going to come up with our purchase budget in dollars. But we're going to start with our production units. So our production units are right here. And we'll go over and do this. All right, times the materials required for each unit in pounds. So if I look here, it says our manufacturing cost is $11.50 per unit. And right here, it says that we use half a pound of materials in each unit. So this is going to be 0.5. So if I multiply my budgeted production units times the amount of material I need for each unit, it tells me how much material I'm going to need this month. So in April, I'm going to need 4,850 pounds of materials. In May, I'll need 4,950 pounds of material. And in June, I'm going to need 5,200 pounds of materials. Then I'm going to take the budgeted ending materials inventory and let me see. So our company policy calls for a given month's ending raw material inventory to equal 50% of next month's expected materials needed for production. Okay, so I can do that. So I'm going to take how much material I think I'm going to need for next month and times it by 0.5 for 50%. And then I'm going to subtract my beginning material inventory. So again, going back, it says my March 31st inventory is 2,425 units. And I'm actually going to subtract that. So this formula is very similar to our production units. We're going to take the budgeted material required plus whatever we want to have left over in ending inventory. And we're going to subtract what's already sitting in beginning inventory to find out how many pounds we want to purchase. Then we are going to multiply it by a price per pound. Again, I'm going to go to additional information, and my price per pound is $12.70. You can see that right here, $12.70. So I'm going to type in $12.70, and that tells me my budgeted materials in dollars is $62,230. That's how much I expect to spend in April. All right. I'm going to pause a second, or what I'm going to ask you to do is, why don't you pause the video, complete this for May and June, and then come back and we'll do it together. So let me give you a second here to pause. Okay, we're back. So for May, I am going to say I need 50% of next month's required materials. So it's going to be the 5,200 times 0.5, and our beginning materials is going to be last month's ending. That means I need to purchase 5,075 pounds in May. In June, I don't know what my ending materials inventory is, so let me see if they've given it to me. And in, here we go. They say here on row 15, the company expects to have 2,100 units of materials inventory on June 30th. So on June 30th, my ending materials will be 2,100 pounds. And then I'm going to subtract last month's ending inventory is this month's beginning inventory. And I know in June I need to buy 4,700 pounds of materials. My price per pound isn't going to change, at least for my budget purposes. And so now I know in May I have to buy $64,452.50 worth of materials. And in June I have to buy $59,690 worth of materials. All right, 2 more and then we'll take a break. So now my direct labor budget. How much labor am I going to need to purchase? And this is going to help us with scheduling and understanding, do we need to hire? Do we need less people? What do we have going on? Okay, so our budgeted production units is where we're going to start. You can see how important it is to do these in order. Okay, times the direct labor required for each unit. So the direct labor for each unit, if I look right here, says it's a quarter of an hour and we pay people $15 an hour. So right here I'll put 0.25 for a quarter of an hour. And if I multiply by the number of units I expect to make times how much direct labor I need per unit in hours, which is 0.25, then I know I need 2,425 direct labor hours in April. Then my cost we said was $15 an hour. If you're not sure, go back. You can see here $15 an hour right here. Okay. I'm going to cancel that. All right. And so our budgeted direct labor dollars is the number of hours we need, which is 2,425 times $15 an hour. So our labor budget in dollars will be $36,375. Go ahead and pause here and finish your direct labor budget, and then we'll do factory overhead. Okay, we're back. So I'm going to finish my direct labor budget. I'm going to copy over the quarter of an hour because that's not going to change, and the $15 an hour, which is also not going to change. Okay. So now, and I can just copy over this formula, which basically says, in May, if I'm going to make 9,900 units and I need a quarter of an hour each unit, I'm going to use 2,475 hours. And if I multiply that by 15, I'm just copying and pasting my formula so I don't have to retype them. Then I'm going to spend $37,125 in May. In June, I'm going to produce 10,400 units. I'm going to need a quarter of an hour of direct labor for each unit, which means I'm going to need $2,600 of direct labor. At 15 bucks an hour, my direct labor bill is going to be $39,000. All right, let's look at overhead, and then we're going to take a break. So to calculate our factory overhead budget, we are going to start with our production units, just like we always do. I'm just going to copy those over. Okay, times our variable factory overhead rate. So if I go over here on row 10, I see our factory or variable overhead rate is 90 cents per unit. So I'm going to enter 0.9. And when I multiply the number of units I'm going to make times my variable overhead rate per unit, I get 8,750. Then when I go to my budgeted fixed overhead, it says here it's 50 cents per fixed overhead, but it also tells me that my fixed overhead consists entirely of 5,000 monthly depreciation expense. Since we know our fixed overhead is 5,000 a month, that's the number we're going to use every month. And then when I add those two together, I am going to get an overhead budget of $13,730 a year. Go ahead and pause here and finish May and June. I'll come back and show you the answers and then we'll take a break. Okay, I'm going to copy over my rate and I'm going to copy over actually my formulas as well. Yikes, we better undo that. Copy. Okay, so my formula here takes my 9,900 times 0.9, and here it takes 10,400 times 0.9. That gives me my budgeted variable overhead. My budgeted fixed overhead is going to be that 5,000 of depreciation. So my total budgeted overhead for May is 13,910, and for June is 14,360. Okay, that gives us our sales and product cost. Why don't we take a break, however long you need, since you're doing this on your own time. And when we come back, we're going to talk about our sales and administrative budgets as well as our capital expenditures. So I will see you then.